let's have a few minutes to think about the markets then, Mark. And let's start with that yield catch-up that you describe over in Asia. I mean, this was something of a theme last week, even though we were in a bit of a macro vacuum. I suppose what we're looking for this week is whether we get data that supports the view that yield move should be sustained and that yields should go higher.
Yeah, so going into last week, the backdrop was that monster jobs print, and it really was just a one-off print, but it does emphasize a story we've been talking about for months, which is the US jobs market remains incredibly hot. Yes, it's cooling a little, but just cooling from incredible levels. So no matter how you look at the jobs market, it is still very strong, and that means the consumer is staying strong, and we're seeing that in earnings as well. They are spending at the moment. So that was the message we got into last week without many more major macro data points, that hey, the economy might hold up and fuel another wave of inflation. Therefore, the Fed will have to hike further. On top of that, we got a few central banks surprising hawkishly, and then the end of last week finished with Canadian jobs kind of emphasizing that this job story is global. So I think that's why we're so nervous going to the US CPI. We know that a lot of the short-term technical reasons for inflation to come down very quickly in the second half of last year have now passed. We know that the first few months of this year are likely to see a few upticks, and I think that's making the market very nervous now.
Right, making the market nervous, even though we have lots of conversations about how backward-looking data can be from labour markets. Let me ask you, though, about how this is going to be played in markets. I know the team has been looking at the yield story, the Treasury story, and thinking about the best way to play the CPI print. And there's a lot of focus on the short ends of the US yield curve.
So I will say as a team we're a little bit divided on this as the market out there, but you know what, I've got the mic so I can give my view. I think that ultimately front-end yields still have a lot higher to go in the US. I've kind of very much in that view, and as a result I actually think the curve will invert further. People have got very excited about the inversion getting the most since 2007. I think ultimately we'll get more than 100 basis points in 2s, 10s inversion, maybe much more, because I think the Fed will have to go significantly further later on this year. Not at a rapid pace. We may not get the big rate hikes again, but I think they'll have to go further, and therefore the back end will stay a little bit more anchored, and we're not going to get the steepening for some time yet, maybe not till the third quarter.
We're going to get an update shortly, Mark, on the shooting down of these unidentified objects in American airspace and reports about what might follow out of China. It's not very often I get to ask you about UFOs and ask if there is possibly, in any sense, any market impact. But it is a very well-read story this morning. A lot of people are talking about these stories. I guess from a market's perspective, it's just a wait and watch.
Look, it provides a little bit of a surreal undertones to market at the moment. Absolutely, people are very interested in what's happening on the balloon story, what's happening in the UFOs. The mentions of aliens I thought was just hilarious out there. Look, we had a global pandemic we didn't predict a couple of years ago. We had a war we didn't predict. Why not get aliens thrown into the mix? But more seriously, this is adding to a little bit of the risk aversion, because everyone's going, why suddenly are they ratcheting up the tensions suddenly now? Remember, these Chinese balloons have been around for a while. Taiwan said they've seen one almost every month for a couple of years. Why is US suddenly getting aggressive? That shows the increase in tensions between the world's two largest economies.